Good afternoon and welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and analyze the four major market indices. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the four market indices and try to get a good gauge on what kind of market environment we're in, we're also going to go ahead and take a quick look at the U.S. dollar. We're going to also look at oil, gold, silver. We'll take a quick look also at a couple of cryptocurrencies like Bitcoin and Ethereum. And then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat. I'd be more than happy to go ahead and take a look at it. If you're watching this as a recording, you can always find me on Twitter at StockDarts, or you can find these recordings at YouTube under StockDarts, or you can visit me at patreon.com/StockDarts, where I post weekly blog content including trade ideas, as well as expanding on the general information we come across during these Wednesday market reviews. Generally what we want to do is try to figure out what kind of market environment we're in, and then try to tailor our trading strategies to match that. That way, you have a market that's rallying strongly, you know you're supposed to be taking long trades, and conversely, if we have a market that's correcting, we know to either stand on the sidelines or begin looking at taking short trades, which of course has not been a very profitable strategy for quite a while now, because the market has been in rally mode for a really long time. However, we always want to go ahead and make sure we understand what kind of environment we're in. Sometimes the market will be more choppy than others, and that will dictate the types of strategies that we go ahead and try to take. So what we do, and what we're about to do now, is like I said, we're going to try to analyze the four major markets and see exactly where we stand as far as price action is concerned. So first thing we're going to do, as usual, is take a look at the S&P 500 through the ETF SPY. And as you can see, we are at new all-time highs, and in the midst of what is now a 5-day bounce in the overall markets. And so this, of course, is pretty bullish. Things are looking strong, as has been the case for a long time now. And honestly, really, the only issue at this time is the fact that this move and the moves that we've seen recently, by recently I mean over the last couple of months, while they seem to be reflected pretty clearly on the overall markets, it's not quite the same underneath the surface, as we have some names going up and some names going down, and in reality it's more of a stock picker's market as money rotates between different sectors. However, overall things are still good, and basically we have still been in a situation where you just want to buy dips, and you don't want to get too caught up in chasing extended moves. And there's another behavior pattern that I wanted to point out here, which I wrote on my Monday blog on Patreon, which is that it's been the case now that we've been stair-stepping pretty steadily, and right before we go ahead and ramp up and push to new highs, we keep getting these little shakeouts, right? So you can see what happened last week. As we closed the week, we had a bit of a shakeout, and then we had some positive action to close the week. The last time we were in a consolidation range, it was the same thing. We had a shakeout, and then we just turned around and rallied straight back to highs, and then eventually it culminated in new all-time highs. If you take a look at the time before that we were in a long consolidation range, again, we had a nice little build-up to right before the breakout, and then we had a shakeout, came all the way back down to the bottom of the channel, and then broke out. And you'll notice each one of these shakeouts has actually come back down and tested. And even if you come all the way back to what we saw in February, March, and April, it was the same general scenario where we had a market that was consolidating, we had a shakeout that led to a move right back to the top of that range, and then we had another shakeout right before we extended and broke out to new highs. And so this has become a pretty clear pattern that has been repeated over and over this year, where we have a market that is, if you look at it in just the context of the longer term picture, it's just a clear rally, right? We're just rallying pretty steadily and going up. Now, if you drill down into shorter time frames, particularly for traders that like to swing trade from periods of holding their trades for a few days to maybe a week or two, it hasn't been quite as clean as what this chart will tell you, right? Because we've had several periods of month-long or 2-month or even 3-month-long sideways action where we're just chopping back and forth. And so if you're a shorter term or shorter time frame swing trader, which is typically what we try to focus on when we look at our these videos, and when we look at when I write on my Patreon page, is it's not actually been that easy to trade if you're just going straight off of long trades, because we've been going back and forth, and there's been a lot of times where the market doesn't really go anywhere. Now, as I alluded to in the beginning, even when the market's not going anywhere, there are different sectors of the market that have taken turns rallying while other sectors go ahead and take a break. And that has been the focus for the most part this year, has been to try to catch that seesaw as it goes back and forth between different areas. This, of course, is in direct contrast to last year, where you just wanted to be basically invested in tech names and names that benefited from us being quarantined. This year's been different, and I know for the most part, for those of you that are regular watchers, a lot of the times we break down our two basic divisions of the market right now into recovery names and into COVID or quarantine names. But the truth is, this year there's been a little bit more of an interplay where sometimes it's energy that's going up because of oil, sometimes it's going to be financials going up, and there's been different areas of the market that have kind of taken turns, but that's still that larger division of recovery and the tech names that benefit from us being quarantined. That division is still kind of played out, and there's still been a lot of seesaw action back and forth between those. And so those are a couple of different ways that you can go ahead and try to approach your trading, is even when the market is kind of struggling, or even when we're breaking out, those different areas of the market are taking turns bouncing back and forth. And lately it seems to be taking a much more rhythmic, just go back and forth as profits get taken on one side and go back to the other. And so it's important for you to kind of keep an eye on this relationship and see how long it plays out. If we see that relationship change dramatically, that's probably a precursor to change that's going to happen in the overall markets as well. And so that's something to keep an eye on. Now, I will point out that it looks like we are starting to get more tired. This is something I pointed out last week, and it's something that I've been anticipating for a few months now, although it hasn't fully played out yet. But I feel like this rally is starting to reach the upper edges of what it can sustain itself, and at a point pretty soon we're probably going to shift towards a more sideways environment, at least in the short term. I don't think that's necessarily a bad thing. I don't think that means the bull market will be dying down. As we get into other charts and we take a look at the NASDAQ, you'll see that the NASDAQ already kind of went through that shift a while ago and then turned around and started resuming climbing again. And what ends up happening is the longer these channels persist, the more likely that when we do get a correction, it's going to be much quicker and much steeper than maybe if we were to finally break this channel and spend some good time consolidating sideways and really start to get new buyers to come in. What tends to happen here is these markets or equities rally as long as something like the S&P 500 is done in such a tight channel is the money kind of gets tired, so to speak, because what happens is you basically have the traders that have been early, have been holding all this time and slowly taking profits, and the new money that's coming in is coming in at a disadvantage because they're buying at prices probably higher than what they want. And so we term those people weak hands because they tend to be the first to come out because they're not coming in at the same advantageous value spot that some of the earlier buyers got in. And so what ends up happening is the more and more that traders get in at prices that aren't quite the super value that we had earlier, the more likely they are to abandon their position as soon as we start to see a correction, and that of course builds upon itself, and that's when you get those quick drops. And if you'll notice, that's what's actually been happening this last couple of months, is that we get the beginnings of those shakeouts, and it shakes out the weak hands, and then you have the stronger hands that know where support is, and they come in and buy the support and take advantage of these bounces to the upside. And this is a story as old as time. If you're a trader, it's the typical market behavior. It's something that you can almost set your watch to. This happens on equities all across the board. And this kind of price action is, like I said, it's indicative of human emotion and human psychology, so it doesn't really change. And it's really just a matter of the right type of trading mentality to go ahead and take advantage of it. Now, of course, not every dip is bought, and eventually charts break. And so what you want to do is, of course, you wait for dips, but then you wait for the green candles to show up and tell you that buyers are indeed supporting and defending these areas once again. And so, like I said, this is really a pattern that's been playing out for a while now. And according to that pattern, what we're going to see next is we're going to run to new highs, which we just did, and now we're going to eventually top out, or at least find a ceiling, and then we'll enter another period of consolidation, and we'll go ahead and we'll challenge these moving averages, we'll challenge this channel, and repeat the same process that we've repeated already basically throughout the entirety of the year. And like I said, if you'll notice with this one, we've started to run up already, and we are reaching a point now where we're probably going to be pretty close to finding the ceiling for this short-term move, and we have a lot less space to consolidate sideways right now. And again, this is a function of how long and how old this rally is starting to get, where we are starting our rallying points, and you'll see this happen again in June, where we broke out pretty close to this channel. We kind of drifted up sideways, and then we had to really shake out again, and then eventually build up with a second quick bounce in order to have more space to kind of correct horizontally. And that's probably going to be the same situation here, where unless we get another massive breakout candle coming out to really extend this move, more likely than not, we're going to drift right back into these moving averages and begin threatening a breakdown of that channel again, and see what happens next. And so, as far as how do we go ahead and approach this and how do we go ahead and try to trade this, I think we'll have a clear idea of our trading mentality as we go through all four indices. But if we're just looking at the S&P 500 in a vacuum, I would say at this point you've missed your move, right? We've already gotten 5 days of buying, and at this point risk reward is not good if you weren't involved in this. Now that doesn't mean that there aren't going to be areas of the market that provide better risk reward depending on where they stand compared to the overall markets. But like I said, if you're looking at the S&P 500 in a vacuum and looking at Trade Spy, you missed your opportunity. And at this point, what you want to do is wait for the next drop back into this area and see if this is going to indeed hold for yet another bounce. The other thing you could look for is a bull flag, which maybe we have another 2 or 3 days of sideways, and then we go ahead and we start trying to break out again, and then you could ride the momentum higher. But as of right now, you wait. You just wait for some key areas that we're about to identify that we can use either to buy the dip or to play a breakout. Or if you want to be patient, you really want to be patient, wait for it to break through that, and then look for sentiment to really start to shift where traders get a little bit more scared. And then that's typically when it's a good time to go ahead and try to buy another dip, right? So let's go ahead and identify some of those key levels. Now we're going to zoom in a little bit because we don't need to see any of that February or March price action anymore. And as you can see, when we pull back, we have several underlying areas of support that are going to come up to kind of propel price to kind of slow down. The first, of course, is the 20-day moving average and the 50-day moving average. The two moving averages, they have supported price throughout the entirety of this year, and until that changes, we have to assume that they will support price. Now, the 50 has been a much more substantial supporter of price action than the 20. The 20 has been more of a barometer for exactly where we're headed. And when we break the 20, we just go straight to the 50, bounce, chop between the two, and then eventually break back out. And you'll notice that happened here in May. It happened really quickly in June, and it happened again even more quickly in July, and then now again with only 2 or 3 candles, it happened again in August. It's starting to happen more frequently, which again is a sign that likely this is a relationship that will not hold too much longer. But until it changes, we have to assume that it's going to continue behaving that way. Alright, so the key levels after the 20-day moving average, we have our channel, which has held its significance for the most part. However, I feel like it's becoming a little bit less significant right now because it is right smack in the middle of the two moving averages, and I consider the moving averages in this particular situation to be more significant than the channel. When you have a very strongly trending equity, I've found that the moving averages tend to do a better job of predicting where it's pulling back. And when you have a more structured channel or more structured trend, then it's the channels that often, especially the more horizontal you get, the channels tend to become more significant, and the moving average is a little bit less significant. Now, of course, it's always up to interpretation, but that's, in this particular scenario, what I feel like is the case. We also have some horizontal levels that are going to coincide with these moving averages and this trend line, which again are going to be important as well. I'll extend them. I don't think that the one on the upper edge is that significant. I think that this one in particular, the 438 level, is a little bit more important because it is also the ceiling of the previous channel or the previous consolidation range. However, they both form a nice little band that we can assume will hold their support. And as you'll notice, this little area also falls right smack in the middle between the 20 and the 50. So we have a pretty good area here that should serve as at least initial support if we do end up kind of falling back off of these prices that we're at right now. And that should bode well for the ability of this channel to survive a bit longer, assuming that we pull back in the next few days and retest all of this potential support underneath us, right around this 442 level. However, if we don't head back into this level until after we've maybe spent another 5 or 6 days trading sideways, then we come back down, well, then that's a different case, because at that point we'll be on the wrong side of this channel and on the wrong side of a couple moving averages. However, I still consider this to be an area that when we test it again will likely lead to at least a temporary bounce and then see what happens after. Now, if we do fall below the 20 and the 50-day moving average, we have a major level of support here around 422, and I don't expect that level to be breached on the first or possibly even second and third passes of it. We would need some serious news coming out of left field that really shakes the markets in order for us to break this level in the near future. Now, I'm not saying this level's not going to break. It could break in a month and a half or 2 months from now. But if we're talking about price action from here to next week or the week after, this level is more likely than not going to not be breached. Even if we make it from where we are now to this level in 1 week, there's a very good chance it's going to hold, despite how negative the move down to that level would be, because that's going to be a strong area that, as you can see, has already flipped from what was resistance to support, and will likely be a stronger test of bulls testing or ready to buy, as opposed to some of these shorter term areas where we're still pretty elevated up here. So these aren't really strong areas of value. They're strong areas of temporary support, but they're not really good longer or even intermediate term levels that bulls can be a little bit more confident in. And I think the buyers would be a lot more confident in this area if we came down to that level. Now, again, I don't expect that. I think more likely than not from here to next Wednesday and possibly even the week after that, we're just going to spend mucking around these areas, maybe a little bit higher as we go ahead and explore some of the upper levels of this channel that haven't been touched in a while. And what I mean by that is if we just go ahead and draw another, now this is obviously not any kind of a significant trend line, but if we draw a line across the middle of the channel, you'll notice that we haven't spent any time on the upper half of that channel for quite a while now. So it could be that we extend this and start trying to explore the upper side of that channel. But more likely than not, we're going to just kind of muck around here between the lower half of this ascending channel and some of these lower levels of support, and stall out a bit as we wait for some other sectors of the market to kind of pick up steam again. All right, so that's the S&P 500. Let's go ahead and move on to the NASDAQ. You'll notice with the NASDAQ a sort of similar picture and yet sort of different. Once again, we have a major breakout. Now, this I did point out last Wednesday that I thought tech names, despite the fact that they were selling off, I thought that they would indeed be a good buy the dip opportunity, and I thought that the seesaw of rotation in and out of tech was going to come right back in, and that has kind of played out, and we've seen the tech names kind of bounce back up. And again, we're at new all-time highs. Another index that is very strong. Now, something very different here, which is what I alluded to earlier when we were looking at the S&P 500. If we go back and take a look at the longer-term picture, you'll notice that the NASDAQ, it has not been stuck in that same channel that the S&P 500 has been. And you'll notice that channel was broken way back here in February, so beginning of the year. And instead what happened was the NASDAQ shifted towards a more sideways time-based consolidation or correction, where we spend more time going sideways and really exploring where support was. Then eventually we stair-step to the next level, and even then we didn't really extend it as a channel to kind of rally off of, and we didn't really break out back until June, where we started to see money finally rotate back into tech names with a little bit more strength. Now, again, this pattern has been different. You'll notice again we've spent more time sideways. We didn't have a channel that we could kind of maintain for a long period of time, and this is basically a picture of that seesaw action that I was mentioning earlier, where you have money rotating into tech, rotates out of tech, rotates in, rotates out, rotates in, rotates out, and now it's rotating back in. We'll see how long this lasts. The rotations are getting a little bit shorter, especially over the last couple of months, so it could be that we bounce a little bit further and then come right back, or we just head right back down. It's a little early to tell right now. What I will say is, just like the S&P 500, if you're looking at this now and trying to figure out when do you get into tech, you missed it in the short term, and I think you need to wait now till we get another either retest of this level up here around 368, or even a little bit further back down. Now, we don't have quite the structured price action that we're seeing on the S&P 500. In this case, we're going to have to rely on the moving averages for now, and this particular lower term level. So if we're looking at key levels, this is a textbook breakout, and again, the same pattern that I mentioned earlier, where we have a consolidation, we have a build up to a breakout, then we get the shakeout before the breakout, right? And so this is often, this actually gives you a lot of fuel for these breakouts, because you have traders that start to maybe think about shorting, and then they end up having to cover, and then also you have traders that stop out, and then they kind of panic and try to get back into their trades, and so they kind of jump in and chase the price action upwards, and that kind of fuels these moves upwards. And so that's what we're getting here. Now the next step that you typically see in this is you come back and you pull back and you retest the breakout zone. And so this level around 368 should be a pretty good buying opportunity. And I think that this is a good picture of, I think a good picture that tells you that there's a good chance that we don't break down in the near future, is because the NASDAQ has a pretty bullish alignment, right? So if we look at the S&P 500, I think the S&P 500, of course, is a bullish alignment as well. But there's more of a threat here for negative price action if we falter and can't hold at these levels. I think with the NASDAQ, there's a little bit more margin for error, where we could pull back or trade sideways and not really have a threat of breaking our trend. Now, yes, if we break below the 20 and the 50, then we've broken the trend, in which case it's not a it's a negative picture, but that would be the same case with the S&P 500. However, the NASDAQ at this point can trade sideways indefinitely, and it won't be an indictment on this potential rally, because it could go sideways and not really break any kind of trends. It only has to worry about when the moving averages catch up. So in this case, this is a little bit more of a bullish chart that shows the potential for it to kind of come back, dip, touch this, and then just take off again. Overall, it's a pretty bullish chart, and really the only negative is that risk reward is not where it needs to be if you want to go ahead and try to trade tech right now. Now, if we're looking at key levels, obviously the first key level is this 368. We've got the 20-day that's going to basically coincide with that. Beneath that, we have the 50-day, which also will, at this point, is kind of right up with 360, but it'll be above it whenever price comes to meet. But the 50-day and this area around 360 will be another temporary area of support. And then just like we mentioned with the SPY, the real key level is way down here around 342, 343. And this is a level that I do not expect to be broken anytime soon. And I think if we do come back to that level, while it will be indicative of a market that is no longer rallying, I think it will still be indicative of a market that is still a bull market and is just spending more time kind of forming out a more broad sideways consolidation range or base. And I think that this would be a good floor for that base if that does come to fruition. But again, I think at this point, if we're looking at it from here to next Wednesday or the week after, this is not in the cards right now. What we're looking at, again, is price action staying somewhere around here, and just kind of maybe bumping into the moving averages, or exploring a bit higher and seeing exactly where traders will consider this to start to get overpriced. Again, nothing negative here. Everything here is very positive, and I think more than anything shows that the market is again starting to get rally mode. Now, as we move to the Dow, you'll notice again a very different picture, and I think again this points to that seesaw that I've been mentioning between the recovery names and the tech names. And you'll note that when we met last Wednesday, we were looking at a different picture altogether, right? Or even the Wednesday before that, the Dow Jones had broken out, while the other two indices were kind of stuck in neutral, right? So if you take a look at what happened here, so we're looking at the 18th and the 11th, right? So on the 18th, last Wednesday, you'll notice the NASDAQ was breaking down, and then even before that was trading sideways, right? If we look at the Dow Jones, on the 11th, it was breaking out. On the 18th, it was kind of doing the same thing as the NASDAQ. So everything was pulling back last Wednesday. But prior to that, we had a nice move up, right? And so this was the seesaw where money came back into recovery and out of tech. And now we're seeing the opposite, where money is coming into tech a lot stronger than it's coming into the Dow. Now, that's not to say that Dow's not bouncing. It, of course, is bouncing just as much as, or it's bouncing just like the NASDAQ and the S&P 500 are, but at different at different levels of strength, and that's because again, the overall the markets are still moving up, but we're seeing money rotate more strongly into tech right now, and not quite as firmly into some of the recovery names that are in the Dow Jones. Now, is that going to continue, or are we going to see another flip flop? I would imagine more likely than not we will. It's just a matter of the timing of when it's going to happen. Um, I personally still focus more on tech. I find that to be the stronger growth names that behave better the longer this goes on. Uh, but there's money to be made in looking at both of these areas, and I think the key is to make sure that you are finding value in stocks that are temporarily depressed in price because money has rotated out of them, but is likely to rotate back in. So, like I said, with the Dow, this is still a bullish chart, but it's not nearly as bullish as what we just saw with the S&P 500 and the Nasdaq, because we're not at new all-time highs. We are actually struggling to re-enter the channel that is held for quite a while now. Now, if we zoom out on the Dow Jones, now I mentioned last week this channel has lost a lot of significance in my mind because it already we had a breakout to the upside, which started to invalidate the importance of it. And then we had this massive base that again just kind of cut a swath right across a lot of price action. And then you saw that we basically threatened to break this channel twice, and actually did so before we kind of came back. And I think at this point, you can even look at this channel as maybe an even broader one, something like this, right? And I think that's actually what we're going to do for now, is we're going to go ahead and shift it and get a little bit of a broader picture. Now again, I think more than anything, the moving averages right now are starting to play a little bit more of an importance, and with this massive base that is formed, we're likely going to see new channels and new directions that emerge from it. But for now, these are still the remnants of the previous sentiment, and still something to kind of watch. And as you can see, it still has sort of climbed upwards based off of that. But just like the S&P 500, we don't have a lot of room here before it starts to threaten another breakdown. And eventually, maybe we see something like the Nasdaq, where we're going to need to shake out and break through that channel and spend some time trading sideways, and really just kind of say goodbye to that trend, and not have traders still rely on those ascending trend lines to try to give them a guide as to when to buy. I think we're going to need to maybe focus more on price action and come down and test horizontal levels. And that's where the Dow Jones kind of is right now. It's starting to threaten to do that again. Now, it hasn't done so, and every time it has threatened, we've gotten the shakeout and the breakout, and that's kind of what happened here. So there is the potential, particularly if we see the S&P 500 and the Nasdaq continue to rally, that we will also see the Dow Jones play catch up and get back to all-time highs. However, keep an eye on this, and if we see it start to get below the 20-day moving average and start to challenge this 351 area, then maybe it's a harbinger of more correction coming in across the board rather than just on the Dow Jones. So this is a good one to watch if you're worried about negative price action, because it will be one of the first ones to kind of break down through some key levels and might lead you to have maybe a little bit of a step ahead of what's happening with the other two. And then finally, we have IWM. Now IWM is completely in a different place altogether. Now, the good thing is that it has rallied very strongly over the last 4 days. It had a lot of catch-up to do. It still has a lot of catch-up to do. But I think that this move in IWM is a good sign that traders are feeling confident in the very short term. And again, maybe it's just that they're seeking value, and this was by far the most depressed area of the market. But the fact that traders are taking risks and putting money back into small caps, at least in the short term, is a good sign. And again, the Nasdaq has broken out pretty steadily, and the S&P 500 has. But as you can see with IWM, it is nowhere near breaking out to new all-time highs. And as a matter of fact, was challenging to break below its 200-day moving average, which is it's a pretty well followed barometer, or widely followed barometer, for what is considered a bull or bear market. There's a pretty good chunk of investors or traders that basically assume if a stock is above its 200, it's bullish, and if a stock is below its 200, it's in a bearish market or a bear. And as you can see, IWM was actually threatening to fall below the 200-day, which is a pretty big sign and a pretty big indictment on the strength of the small caps. it held for now. And ideally, if we are going to continue to see a persistent bull market like we've seen all year, well, IWM needs to get away from this, and it needs to start making its way back to the top of the range, and it needs to start participating in rallying with the rest of the indices. Now, I will say this: over the last 10 years or so, um, the markets have done a good job of rallying, even when IWM did not participate. If we go to a weekly chart and just take a look, as a matter of fact, I'm going to go to a monthly chart, and we take a look at what IWM has done, and you can see that there have been times of explosive movement in the small caps. But and again, we're going to go basically we're going all the way back to the 2007 2008 drop, um, and what happened after. And as you can see, the markets eventually bottomed out and rallied. IWM rallied, but then there was a point here from 2014 to 2017 where IWM was stuck in mud, while the other indices, and we could take a look at, say, the NASDAQ, and see what it did. And you can see it was basically an uninterrupted climb this entire time. And if you take a look at the S&P 500, for the most part, it did have a small period of consolidation around that time, but not quite as it didn't struggle as much as IWM. And there have been periods where IWM is trading close to the lows while the other market indices are trading close to highs. And so if IWM is lagging, that doesn't necessarily mean that we can't rally as a market. But what it does mean is that sooner or later, though, it's going to taper off, because we're not getting a full-fledged participation out of all parts of the market. And when you have, say, last time we saw that was in November and December of last year and the beginning of this year, all four indices were strongly running up. And when that happens, it's typically when you get the best trading conditions. When you have a couple indices that are trading up and a couple that are trading sideways, you still have decent trading conditions, but that's when you get more into this stock picking market, or this seesaw market that I've been describing today, where money rotates in and out of different areas, rather than when the market is, all four indices move up like we did in the holiday season and end of year. Everything goes up, and it's very easy to trade during those times. We're all geniuses when we're trading during that kind of market. However, when we're trading like this, it seems like we feel like we're bumbling fools, because the market just goes back and forth and really gets into your head. And so what we're seeing right now is hopefully the beginning of momentum coming back into IWM. And if that's the case, we could maybe be setting up for a continued expansion back up towards the top of the range, and that will bode well for the other indices. If IWM falls right back and hits the 200 and falls back below that, I think it puts a lot of pressure on the other indices, but it may not necessarily mean that our bull market is dead, but it might still mean that we're going to have a little bit of more trouble. So keep an eye on IWM now. Key levels, we're almost at a key resistance level. It feels weird talking about resistance, because with the other indices we don't really have any. The Dow Jones may be all-time highs, but with IWM we actually have a pretty strong ceiling here that has been starting to develop. And as you can see, this is really just an extension of this trend line that was already in place from all the way back in March and April. But basically it's we kind of came up, broke out, came back down, and then we've been kind of really struggling to get back above this 225 level. And that's the first level that needs to be broken in order for IWM to really start to participate with the other three indices in challenging the all-time highs. If we get rejected at this price again and head right back down, then it's not the end of the world, because really it just means that this consolidation range it's just extended further, right? I mean, if you think about it, IWM has done nothing more than just bounce between 207 and about 233, 234, back and forth, and we're right in the middle of that. There's a good chance we come back to the top of that. It doesn't even really mean we're going to break out, because it's just range bound. And so it's a very different picture from the other indices. I've said before, I consider this to be an indication that traders, while they're still bullish, they're now full out bullish, and they still have one foot out the door when it comes to some of the riskier assets, and they tend to have a little bit more faith, I think particularly in a lot of the tech names, which is why I tend to go back to them a lot when I go ahead and look at my trading styles, or when I look at my potential trading opportunities, like the trades that I put in the Patreon page. So that's what we're looking at now. As a whole, the markets are in a good place, right? We've got the S&P 500 and the Nasdaq at all-time highs. You've got the Dow Jones just below all-time highs. Uh, so overall, we're still in a pretty bullish market. Like I said, worst problem or the worst part about this right now is just risk reward is a little bit difficult if you're trying to initiate trades today or even yesterday or the day before, because we've already bounced, right? Um, and so what we have to do is, like always, is just kind of stay disciplined. Don't feel like you're missing out, and that if you don't get into this now, you're going to miss the boat. I think that a lot of this bounce is, the bounce that we are going to see has already occurred. I don't think it extends too much further. I think we've already reached the spot where we're probably due for a little bit of a sideways drift at the very least. And at that point, then maybe you get stocks that kind of give you a little bit better of an entry pattern, and you can go ahead and then maybe try to participate. But the last thing you want to do is chase price action into resistance or into dead space when it's already been up 5 or 6 days in a row. So keep that in mind as far as the timing of any potential trades you're going to go ahead and try to take in the near future. So that's the four major market indices. I'm going to take a quick look at the U.S. dollar, oil, gold, silver, Bitcoin, Ethereum, and then we'll look at charts. If anyone in here has a chart they want me to look at, type it into the chat and let me know what you are looking at, or if it's a question you have, even if it's not a chart that you're trying to trade, but maybe it's just a question you have on a pattern. I'll be more than happy to go ahead and take a look at it for you. So here's the U.S. dollar. Last week we saw the U.S. dollar bounce pretty strongly. This week we see it kind of pulling back a bit. It's still, I think, bullish in the short term and even in the intermediate term because it's holding above a pretty decent range here, around just above 2480 or so, and it's just hovering back and forth around 25. We're not getting a massive, like, full-on breakout, but we're also not getting a full breakdown back into the previous range. And I think we're seeing a trend shift here where the U.S. dollar is beginning to gain more strength and is looking like it wants to start building up some more momentum. If we look at the individual currency crosses, and as always, we'll start with the euro, which is going to be inverse to that chart that we just saw on the UUP index. You can see that the euro is really struggling versus the dollar as it continues to drop. And now it did have a nice bounce here, which of course is concurrent with that US dollar drop on the UUP index. But it's really nothing more than a reactionary, kind of a dead catish type of bounce where we just got a little overextended to the downside, and then it kind of comes right back up and starts to test the now pretty steadily declining moving averages. Everything here points to a euro that is probably headed lower, which means a US dollar that is headed higher. In order for it to change, we're going to need to see the euro start to reclaim these moving averages and get back above the 20. I think that even if it breaks back above the 20, it is likely going to be rejected at the 50 and head right back down. So I would say, generally speaking, looking at the euro-US, which is I think the biggest currency cross or the most significant currency cross, things are looking like the US dollar is picking up strength, and this looks like something that will persist into the near future. Now, that being said, if we look at the US versus the yen, we see a little bit of a different picture, where the US dollar has been kind of stuck in neutral. Now, the US dollar was, and actually, I think, first broadcast some of this incoming strength versus the yen. You can see the massive rally that came in February and March, and it's been kind of just stuck in neutral since then, maybe meandering up a bit and then meandering back down. It's right in the middle of this range, so it's very difficult to say with any kind of certainty what it's going to do next. It likely comes up and tests 110, but it's really just stuck in a little channel here between about 110 and about 109, and it needs to emerge on either side of this before we see something. Now, this again is probably a function of the yen finally picking up some strength as well. It was basically weak at the same time as the US dollar, and it seems like it's starting to pick up strength at the same time, which is making for a little bit of a messy chart as far as change of direction, right? We just have a sideways channel. And then finally we have the US versus the Canadian. And in this one you can see the US dollar is definitely picking up strength, but we're starting to see some violent price action. You can see a big move up and a big move down. This likely has something to do with oil, which we'll get into in a second. But you'll notice volatility is really starting to increase. However, the overall trajectory is still up for the US dollar. Now, I think we are reaching some pretty key levels of resistance right around 128 to 129, and that is likely going to play out in the future where that becomes a ceiling that we need to break through. Um, but overall, I think the U.S. dollar also bottomed out pretty clearly versus the Canadian. And so, generally speaking, this is all indicative of a U.S. dollar that has picked up a bit of strength. That could eventually put pressure on the actual stock market, but for now, that's not something we're seeing. Okay. All right. So now we take a look at oil, and you'll see that violent move back and forth on oil. Now, we actually predicted this last week that there was a very good chance oil was going to break down. It did so. It finally lost support at 65, came down now. It did find very quick support here, just as it started to approach the 200-day. We had a strong move back up. Now, again, just to go back to the U.S. Canadian real quick, that is what is happening here with the U.S. Canadian, because this is a major trade commodity between the U.S. and the Canadian governments. So again, going back to oil, we had the big bounce, and so this could be seen as two things, right? This could be seen as the big shakeout that was needed before oil could start rallying back, right back to its previous highs, or this could be the beginning of a further breakdown. And a lot is going to depend on what happens here, where we are right now. So oil is actually at a pretty critical juncture as it gets back above this 66 level. If it can hold above this and start to get back above the 20, then I think that this becomes a shakeout, and that we're likely going to see oil head right back up to the 70s and then continue trying to play out or flesh out this triangle before breaking out. If oil fails here and heads right back below 67, then I think it's going to move all the way back into the low 60s and probably test the 200-day moving average. So this becomes very critical to see what oil does next. Now, you might be asking yourself, well, what do I care? I don't trade oil futures. But this could be a kind of a proxy for the recovery trade, and it is certainly can be seen as a way of analyzing energy names in the stock market, like oil names, gas names, drillers, shippers, that sort of thing. Anything related to energy is likely going to have fluctuations based off of what oil is doing, especially as it heads into kind of a critical spot here, which is probably going to dictate the next range that it's going to spend time in over the incoming months. So this is still important to watch, even if you're not someone that trades futures or is really concerned or interested at all in trading oil. So keep an eye on what it does next, because I think it might have some important clues that we can gain from it as far as how we want to go ahead and start trading other names that are in the stock market. And then as these become increasingly irrelevant, I spend less and less time in them. But gold and silver, as you can see, gold had a nice little bounce, and then recently with the dollar, it's kind of weird now. The dollar pulled back and gold pulled back with it, and SLV sort of the same thing, where it's just kind of trying to bounce and really stuck here. As I've said for a while now, I am not interested in trading either of these commodities right now. I still look at them just because it's, I mean, almost as a force of habit. And you never know. At certain points, maybe they become better trading vehicles again. But if we look at a weekly chart and we see what they've done this year, right? This is not that profitable. Now, sure, you could look at it and say, well, there's a very clear range here with highs around 26.50 and lows around 20, and you could have played that range back and forth, and you know, it could have worked out for you. If you look at GLD, again, not quite. If anything, it's an even more difficult longer term pattern to kind of trade out, because it didn't really have that clear channel. But the problem with these is that they overnight they have a lot of gaps back and forth, and it becomes very difficult to get clean entries and clean exits when they gap up and down like this. And considering they're not giving us stronger, longer term moves, they're just not worth it to trade, in my opinion. Particularly when I typically look at gold and silver as an inverse dollar sort of correlation play, and at this point, I'd much rather focus on something like Bitcoin or Ethereum, which, while they can be seen as inverse dollar plays as well, trade off of their own momentum. And at this point, especially when you consider that their 24-hour they have 24-hour market cycles that you can actually trade 24 hours. Uh, they're much easier to trade in my mind, and they give you much more volatile and clean moves anyway. And so this is kind of a segue to the last two charts we're going to look at before we get to chart requests. And that is, we take a look at Bitcoin. You can see Bitcoin bottomed out after it had a pretty drastic correction from May to about July. We had a nice breakout here in July and beginning as we moved into August. Hopefully those of you that follow me got into this, because I was kind of harping on this. And we've had a very strong move. Now it's sort of stair-stepping. It's starting to lose a little bit of momentum. And I think we're getting pretty close to a spot where it's probably going to take a breather. It could be that this persists a little bit longer. We might need to come up and retest this breakout first, which is actually still almost $10,000 away from where we are now. But there's a decent chance that we need to kind of backtrack and maybe retest the 45 or even the 40,000 level before we really can head right back up into the 60s. And so if you missed out on this move, I think there's a decent chance that you will get an entry point at some point in the near future. If you wanted to be extremely patient and realize that maybe you don't get this, but this would be a really major level to wait for a pullback if you wanted to get into Bitcoin long term. No, I'm not going to make a promise that it gets back to this at any time soon, because a lot of times with these cryptocurrencies, once they gain some strength, it persists for good chunks of time, and you don't necessarily come back and retest these levels. But if it does come back and retest 40, and you see it hold and you see it start to bounce again, this is a major level to look at. However, it could just be that it kind of retests the 200 and then starts to rally again. I will say this, just like I mentioned before with the S&P 500 and the NASDAQ, your opportunities for Bitcoin are getting a little bit less appealing from a risk-reward perspective as it continues to climb upwards. In the short term, there's still nice little fluctuations here. If you take a look at the little bull flag it's printing now, even if you buy here at 47, there's still a good 2,000 or 3,000 of upside just to get back to the highs from the last couple of days. So there is room to trade here. But as far as room to invest, it's getting a little bit more and more difficult. And it's going to be the same case with Ethereum, which is also kind of bounded upwards pretty nicely. And as you can see, it is basically doing the textbook bullish pattern of breaking through or out of a channel and then kind of coming back and retesting and setting up for another move upwards. And so as long as it stays above 2870 or so, this is a very bullish chart that is likely going to make its way back up to 4,000. If it falls back below this, then maybe you need to come back and reevaluate and see exactly where it comes down, but it'll probably come and test moving averages and see what it does from there. These are still areas of the market that I am highly focused on, possibly more than even the stock market. I mostly write about the stocks on my Patreon page because I assume that's what my readers are looking for. But if you go ahead and if I had to kind of divide my attention into percentages and say what I spend time on, I would say at this point I probably spend more than half my time on cryptocurrencies and less than half my time on stocks. I still trade stocks pretty regularly, but I've found cryptocurrencies to be at this point giving more upside and more volatility, and I can still kind of stop out at the right spots. So that's where I stand right now. That's my basic analysis of almost any trading vehicle you could really look at. If you think about it, we covered the stock market, we covered futures, we covered forex, and we covered cryptocurrencies. If anyone has any questions, now's the time to ask. If there's a chart you want me to look at, go ahead and type it out. If not, we can pretty much wrap it up for today. I think overall, most of these charts are still pretty bullish, and it still looks pretty decent as far as trading almost any of these vehicles. I think really gold and silver are the only ones that really kind of don't interest me at all. I think even oil actually has potential for short and long trades, and could be played in either direction. Alright, well, it looks like those of you that are in here don't really have anything you want me to look at, so we can go ahead and wrap it up for today. Thank you for participating or watching. I appreciate the attendance. Like I said, if you're watching this as a video, as a recording, you can always message me on Twitter, and I'm more than happy to go ahead and answer questions on that medium as well. Have a good rest of this week, and we'll meet again next Wednesday.